Hey everyone. Okay. So yeah, my talk is on tenets of tokenization. My name is Barath. I just want to get a sense of how much usage there is in the crowd for crypto today or here. Who all have used stable coins in their in their life? Okay, great. Who all have used tokenized other sort of real world assets like equities or real estate or something like that? Okay, so that's like pretty decent. To be honest, I expected less because I've rarely touched it, like once or twice in practice. It's mostly stable coins. Um, So before I sort of get into the tokenization aspect, I just want to talk a bit about BitGo and where it sort of started from. So not sure if it's completely legible here, but you can see just a list of all the hacks and attacks that have happened in crypto over the last 15 years. Hopefully, people here weren't really affected by it, but I would say that this is still the number one downside of crypto as compared to real world assets today, because it's so easy to lose crypto. And you can see that over the years, this hasn't really sort of decreased, or at least the graph doesn't seem to show it. But at the same time, crypto's value has increased quite a bit, and usage also has increased over the last 15 years. So maybe it's not sort of super reflective in this graph, but since the value has increased, I do think that theft and crypto hacks have decreased in comparison to it. But this was the problem that sort of BitGo set out to solve back in 2013. So those of you who are not familiar with sort of the product itself, largely it starts as a multi-sig wallet, which is, there's no single point of failure in a multi-sig wallet in which the keys are created in different areas and the transaction signing also is not concentrated in one place. And that adds a layer of security to the product. And that's the base with which BitGo kind of started. But on top of that, we've built a lot of layers, and services to provide folks that use BitGo. So at the bottom is what I talked about, self-custody wallets. So pretty proud to say that BitGo has multi-sig wallets, MPC wallets, hot wallets, cold wallets, self-custody, qualified custody, and different sort of mismatches of these things that you can think of. So for example, you can have a cold self-custody wallet, which is MPC. Very possible. Or you can do different mismatches of these combinations to set up the different types of wallets that you want. On top of that, there is a layer of qualified custody. The qualified custody aspect plays a pretty key role, largely because it's tries to cut away from the bankruptcy protection that you don't usually have in most other cases. So in previous cases of hacks, such as sort of the FTX hack, in which when FTX went bankrupt, users actually lost money. But in the event that BitGo goes bankrupt, user deposits are unaffected, largely because of qualified custody regulation. Yeah, so on top of that, we also have a layer which you can trade, lend, borrow, stake, and do collateral management using the qualified custody, so that you don't really have to take your assets out. And on top of that, we do have our team here who have led different parts of the stack. So we have Satchu, who's leading stablecoin as a service, and we also have Sriraj actually in the crowd here doing token management. So we do have different services on top of the prime layer as well. So largely, this talk is around stablecoins and tokenization. So over the last couple of years, we've created a product in which other companies can launch stablecoins in different markets. And based on that, here are some sort of predictions on what we think that the tokenization market will go to. Oops. Yeah, so just a bit about me. I'm largely involved with Ethereum wallets and multi-sig wallets since 2016, and we do have a large office in Bangalore as well. So the first prediction that I would like to make is, firstly, like real-world assets are set to grow over 100 times in the next 5 years. This actually might seem like a pretty big number, but if you compare it to the total market of real-world assets, we are right now less than 0.01% of the total market. So growing 100x is actually not really that big a deal. And as you can see, like the total market cap of these things right now is close to 25 billion. And this is, of course, like not counting stablecoins, as a real world asset, everything else. So you can see that US Treasury debt is a huge part of it. We have a lot of companies looking into this today. We have Ondo, Circle, BlackRock, some of the big US majors looking into tokenizing Treasury. Then we have commodities, largely led by gold. So we have tokenized gold, and the two biggest products that we have today, I think, are from Paxos and Tether. Both have gold representations on chain. Then finally, we have the much smaller ones are equity markets, though equity market globally is pretty huge. The equity tokenized market is, again, very, very small, probably like 1/10 of 1 BIP of the total market. And even within the equity market, we have public equities and private equities. So before, why do I think that it's going to go 100x? Largely, it depends on sort of some of the use cases that we can find with tokenization of such assets. One of them is, I won't go through all of these, but in general, like, accessibility is a huge deal. So right now, equity markets are tied to a particular geography. They're only tied to a certain number of investors, and they only trade in a few locations. This is both bad for suppliers and the traders. On the supply side, so people who are actually issuing equities want their stock price to be high. But right now, with such a fragmented market, this is not the case. Additionally, from the people who want to buy equities, you don't really have an easy way to do so. So accessibility is a huge bottleneck. Even with private equities, this is set to be more accessible with tokenization. There are other aspects of tokenization that really help as well. I would say like 24/7 trading is something that we're used to in crypto, which doesn't exist in equities today. This is both a possibility with tokenization, though it kind of comes with a lot of caveats as well. One of the things that, or the big challenges that we have with tokenizing of equities is that, just if events happen on the weekends that cause huge price fluctuations, that is just very hard to handle when you have two different markets. It's going to be a huge deal for market makers, but at the same time, it's also going to be a huge deal in the way that markets move over the weekends and how it affects the Monday price of that particular stock. Other actions are also quite complicated in the current equity market. In particular, stock splits and dividend payouts. There's huge confusion around how exactly to implement this in a tokenized format. Because currently, the way that it works, it's kind of like trading stops, these stock splits and dividend payouts happen, and then it kind of resumes. This sort of stop and start model in which we have particular permissioned players acting in order to execute these things are probably not what we want in a tokenized model. There are other challenges as well, such as voting and governance, which are closely tied to privacy, but I'll just quickly talk about privacy in a later slide. So I also want to quickly touch upon sort of the life cycle of any sort of tokenized real-world asset, but in particular, let's just talk about equities just for lack of confusion. Starting off with origination and then structuring, today we see there are two main ways that equities are being structured. One is direct issuance on-chain, and this is pretty rare. Right now, it's being done by Securitize for a few companies. I think Galaxy was a recent one. And even BitGo has the possibility of issuing directly on-chain in the future. But again, there's very 3 or 4 companies purely in crypto that are doing this. The more common method of actually launching a tokenized security is through an SPV model. So what really happens there is that there's a company that buys tokens in the public markets, and then what the tokenized equity really is not a direct access to those companies, but to the SPV in the middle. So many of the voting rights as well as even price might be slightly different in this sort of step market flow of equities. But these two models exist today, and it looks like as if the SPV model is something that is probably going to gain more traction, at least in the near term, but direct issuance could be something that takes a much longer time. The third is distribution. So one of the main reasons that equity and sort of real world assets don't see that much distribution today is largely due to permissions. In the stablecoin world, there's really no permissions in order to transfer assets in a secondary market. But in real world assets, there is restrictions placed on these permissions. There are some assets that trade today which don't have permissions, especially in US Treasury bills, but largely equity markets do need permissions, and this is still a very tricky aspect to solve in order to reach mass adoption. Finally, going back, servicing, I talked about this in terms of dividend payout and stock splits and so on, and redemption and burning is also a key factor, especially if certain geographies can actually do the redemption as opposed to other geographies that can't. So point number 2, we'll just quickly talk about stablecoins as well. Largely today, stablecoins are used as crypto settlement rails for crypto trading. And I think over the next at least 5 to 10 years, we'll see a lot more use cases globally come up for stablecoins. And I think the tech has always been there. It's just that regulation is sort of catching up to this. Some of the other use cases that we'll most likely see is that stablecoins are going to be used to settle other kinds of trade. There's going to be remittance and payroll operations, as well as a hedge against inflation in certain countries. But all this is, again, very hell-bent on the privacy bottleneck, which we probably need to solve from a technology side. So anybody has used this? All right, great. Actually, I'm quite curious to know everybody's opinion on this. I still don't understand sort of how this is different from UPI for the most part, at least from the use of it. I do understand from a technical standpoint it's slightly different in the back end, but when I tried to use it, I couldn't really find any difference. So I'm not really sure where this is headed, but currently in the stablecoin market, even with permissionless stablecoins that exist today in euros and other currencies, the USD dominates easily more than 99.9%. So even if we did launch an INR stablecoin, which is permissionless, which is hard to do, I do think that we will struggle when we did launch. Okay, lastly, I want to talk about some of the regulation that's come up in the US around stablecoins, and I think that this is sort of a precursor to what might come up with real-world assets in the future. First is the Genius Act, which has already been enacted. Largely, it touches on, certain participants can actually issue stablecoins with holding very liquid assets in the back end. In particular, this just means cash and treasury bills. Additionally, you have to report, audits every week, actually, even though it's mentioned as every month here. But then on top of that, a large kind of fight that's happening right now is reward payout in terms of stablecoins. In some cases, rewards are already being paid out today, especially at Coinbase, and I think there are a few other Ondo stablecoins that get rewards. But according to the Genius Act, that is actually not allowed. I do think that future acts will make it so that reward payout for stablecoins is going to become a thing, at least within the next few years. The next one is the Clarity Act, which I think that is still stalled. Largely, it classifies assets as being cryptocurrencies or commodities. And it also, kind of provides a path where one can move from one to the other. the main difference is that the CFTC is much easier to work with than the SEC. And so everybody is trying to move away from being classified as a crypto and more as a commodity. Okay. Yeah. So a third prediction that I want to sort of call out is on-chain privacy will become more mainstream. In the current market today, there are 4 main ways that on-chain privacy is being enforced. I won't really get too deep into each of these mechanisms, but privacy pools led by Tornado Cash, rather infamous, is a huge deal. The second one is trusted execution environments, which I think Vitalik briefly mentioned in his chat today. Then we have ZK rollups, which kind of, I would say, combine a bit of the tech and privacy pools with rollup technology to have both private and public state, and they achieve privacy in a different mechanism. And then finally, fully homomorphic encryption tries to achieve privacy on public chains like Ethereum and Solana, so that you don't have to go on to another chain in order to achieve privacy. Okay, last one, and the last point that I want to mention is sort of the convergence of ICO and IPO mechanics. So over the last, I would say, 10 years, the ICO way of raising money has been much, much more lucrative than IPO mechanisms. Largely because you can basically raise a large amount of funds with very little revenue in the ICO model. I don't think that both of these will converge in the way that the equity tokens and the tokens operate. But at the same time, the mechanics of the auction are pretty much the same today as we see in IPOs. So largely, you have a certain amount of tokens that are held by employees. Second, there is certain amount of qualified investors who can get in early in order to bid for that particular token. They set a particular limit price as well as their budget in which they want their tokens filled. This largely removes other problems that we had previously in terms of last-minute bids or someone front-running your auction. These mechanisms kind of basically solve many of those problems that we saw in earlier ICOs. And finally, you do get a final price for the end retail, which will then also make a direct market in many DeFi apps. So I would argue that the ICO mechanism for actually launching an asset is, in fact, probably superior to the IPO mechanism that we see today. Yeah, that's my presentation. Thanks, everyone. I'm not sure if anybody had any questions or thoughts. If not, I can hand it over to the next one. Oh, yeah.
Hello. Okay. So you told that RWAs will heavily rely on the SPVs.
Yeah.
So, I think BitGo has their open source something related to the wallets and all. But are they looking to develop something for the SPVs as well?
Not yet. I mean, I think that it's still a pretty nascent market, and we do have the ability to launch stable coins with the BitGo SDK, but not really tokenized real-world assets through SPV. We don't have that mechanism right now in many of the BitGo products, but it's something that we're definitely looking into. We do have some announcements on this front, but it's not been announced yet.
Yeah, exactly. That was my question.
Hi, my question is not regarding BitGo or anything personal. I just wanted to get your thoughts on, see if I'm coming from a traditional market. My main concern is about when you talk about tokenization, how do you see the secondary market, which is a big problem statement? Then the second part of the problem is fiat, this thing. And suppose if I put the tokenization, what you talked about, the equity market, imagine a 2008 like a scenario. What happened in a week's time would happen in seconds. You'll have depleted and there's no responsibility. So how do you address, because when you talk about compliance regulatory practices and see if you have a T1, T2, T3 kind of delays in payment. That basically is what it's ensuring, is that it's ensuring compliance at multiple levels, and it can block and you can stop that flow. So as somebody who is working in that ecosystem, how do you visualize this? What would you be, because see, it's very easy to say I'm at 0.001% of that, this thing. But if I have not come to that 100x or something, there is a reason why we have not done it, right? What's your thought process? I'm not challenging, I'm asking, how do you perceive it?
Yeah. Sorry, I will answer this. What was your first question again? Secondary markets. Okay, got it. Yeah. I mean, I 100% agree. Like, the reason that it hasn't reached 100x already, and it's not even at a small scale as stablecoins, is because of all these challenges and restrictions that are there in the market. The secondary market for equities, I think that largely, like, there are only a few use cases that people, really want in the secondary market. One of them is access to private equity. So this is sort of, I think there is some demand for this, but even that, it's only for a few very famous companies. So for example, I think OpenAI and SpaceX were two companies that had private equity token launches in Europe, I think a few months ago. And that was reasonably successful with Robinhood. So that's one use case. The second use case is like secondary market trading on-chain as opposed to off-chain. Right now, it doesn't feel like there's that much difference. So if you did have access to centralized exchanges in order to trade equity, you'd probably just get better execution and better prices there as opposed to decentralized markets. The large one is really about getting global access to equity. I think that comes down to permissioning. Since regulators and sort of people who are launching equities really need to know who are the holders of those equities, we probably need to have a standardized mechanism of permissioning globally that needs approval so that this market can become something that everybody can agree to.
Bitcoin journey, I have no doubts. But when you
Agree. Yeah, there's no success story. That's true. I think largely, like these two problems, like just a global permissioning system in which people know how they can do this in the blockchain is definitely one of those things. And second, it's probably only going to be useful for a few number of assets even within the real world asset. Like, I don't think real estate is actually going to be the one that really moves the needle here. Again, it's going to be probably some amount of equities, but also very specific ones, which are rather famous and people want to buy in different parts of the globe.
Oh, I'm so sorry. That's about it. I'm sorry, we can go on and on about this, but
all
these
good.
are my thoughts.
Yeah, for sure. Okay, sounds good. Sorry, I also want to address your second question, which is sort of the challenge with regards to a large-scale movements, which I did think mention was a problem with real-world assets, with large-scale movements, especially on the weekends or downtimes, and how do you kind of match two different markets, one which is stuck without moving, and one which is stuck and it's completely moving. Yeah, this is a huge challenge, especially for market makers. I don't really think it's too much of an issue with, for people trading, like retail trading, but, market makers have to hedge their bets. And in the event that they're hedging their bets and something huge happens in sort of off times, this is a huge problem. Largely, I think that this will be solved by sort of how it's been solved, I would say, in terms of real-time betting. There will be like times in which you cannot trade and it'll be locked even on chain. It just has to be the case. So previously, if you look at like kind of betting on real world events, basically, it used to be something, it wasn't real time, where there was an event at time X and you could bet up to time X minus 5. And then during the event, again, you cannot bet. But over time, we've come up with systems, at least in betting, in which during the event as well, you can bet. And those things move at a much slower pace, and there are huge restrictions placed on when you can place those bets. So similarly, I do think that even in a freely tradable 24/7 market, such as tokenized equity, there will be large restrictions placed in order to help market makers manage both centralized exchanges and DeFi trading. Okay, thanks for the questions, folks. And yeah, catch me outside the talk if you want to chat. Thanks.